Hello and welcome to this very special interview. Joining me today is one of India's most dynamic financial experts. She heads Edelweiss Asset Management company, Radhika Gupta. Thank you very much, Radhika, for joining me on this investor education series that is brought to our viewers by the Bombay Stock Exchange Investor Protection Fund. Lots to talk to you about, Radhika, as always. But first of all, we talk a lot about equities and shares, etc., how the markets are moving. But very important piece in a portfolio which doesn't get talked about that much is debt. What, according to you, is the importance of debt in an investor's portfolio?
So thanks, Vivek, and great work that you and Bombay Stock Exchange are doing on investor awareness and protection, and always good to see that. I think debt is very, very important. I always say that mutual funds as a movement will not succeed if you think about them as just equity, because we as Indians, we are ultimately savers. And if we advocate asset allocation and having a mix of growth and safety asset classes, then any portfolio is incomplete without debt. Debt plays many roles in your portfolio. It is there to meet your contingency needs, something that has come into light a lot actually because of COVID. And it is there to be a buffer in times when equities don't do well. And any of us who's invested know that there are plenty of times when equities don't do well. So a portfolio is absolutely incomplete without debt. It's a question not of whether debt or not, it's about how much debt and what kind of debt.
So how much debt, according to you, should one have in a portfolio?
So Vivek, I think it is very individual specific, and I think you really have to look at your goals and asset allocation. You know, there are individuals who are significantly more risk taking and their goals are a lot more long term, where debt could be 10-20% of their portfolio. But I think for a significant number of investors, debt will be 30 to 50% of their portfolio, and that's not abnormal. I think the way you should think about this is in terms of, I always think, look at investing in terms of time horizons. There are three kinds of money that people broadly have in life. One is very short-term money, which has to be the ultra-safe debt money. It's the kind of money that I say is contingency money. I need it in 6-9 months. I can't take any risk. That's totally debt money. The second is medium-term money, which is broadly what I say is 3 to 5 year money. And there, I think debt or debt in a part of the portfolio plays a very important role. And then the third is truly long-term money, which is more equity-oriented. But for the first two buckets, I think debt is very, very important.
Always a pleasure talking to you, Radhika. Thank you very much. Keep inspiring, keep educating all investors. We need more and more of that. Thank you very much for joining me here.
Thank you, Vivek.